I was hired by a mid-sized manufacturing company whose owner suspected something was off. In the books, profits were slipping, but sales were steady. As a forensic accountant, I've learned to trust patterns, not promises. I started with the usual tracing cash flow, reconciling bank records, and reviewing expense reports. At first, all fingers pointed to the bookkeeper. Her payroll entries were padded reimbursements, exaggerated, and vendor payments oddly rounded. When I confronted her with the evidence, she crumbled. She had skimmed nearly $60,000 over 3 years, but something didn't sit right. Even after accounting for her theft, the numbers were still short. Digging deeper, I found irregular purchase orders, authorized by the operations manager, inflated invoices from a vendor that turned out to be a shell company he controlled. Another $70,000 bled away into his pockets. In the end, the owner was shocked. Not one, but 2 trusted employees had been bleeding the company dry. We helped him tighten internal controls, separate financial duties, and install proper oversight. But to my surprise, he chose not to press charges. He was worried that if word got out, the company's reputation would suffer, clients might leave, investors might panic, and employees would lose trust in leadership. So instead, he quietly fired both employees, recovered what little he could, and focused on rebuilding. The aftermath wasn't quick or easy. Between the stolen funds and the fudged books, the company had tax penalties, inventory gaps, and shaky vendor relationships to sort through. It took 3 to 5 years of steady effort, financial restructuring, and regaining client confidence before the business fully recovered. It was a hard-earned lesson that theft doesn't just take money. It drains time, trust, and the stability a company works years to build. And sometimes the road to recovery is longer and more painful than anyone expects.